Please stand by while we wait that other participants join. Thank you. Good morning, good afternoon, good evening from Buenos Aires. Today is October 7, 2020. My name is Leandro Passarella. I'm a tax lawyer and professor of income taxation at UTDT's Masters of Tax Law program. Welcome. I'm with Professor Celina Valls. Hello, Celina.
Hello, Leandro. Hello, everyone. Welcome to our seventh session of UTDT Global Tax Talks. Leandro, could you please remind us the purpose of this dialogue?
Yes. Well, following Universidad Torquato Di Tela's mottos of academic excellence, pluralism, and equal opportunity, UTDT Global Tax Talks is a platform fostering an interdisciplinary dialogue among scholars and faculty members from all continents on a single hard tax topic. Based on a common questionnaire, tax law professors, economists, political scientists will share their views on the same issue, offering the audience a comprehensive analysis. In its first edition, UTDT Global Tax Talks will cover the impact of the COVID-19 pandemic on the international tax system. We have a roster of 10 recognized scholars from around the world. We have already conversed with 6 scholars, and we are circling around the globe. Now it is the turn of Asia, more specifically India. Today, we have the pleasure of speaking with Professor Suranjali Tandon.
Professor Tandon is assistant professor with the tax research team at India's leading think tank, National Institute of Public Finance and Policy, Delhi. Over the past 9 years, she has worked on several projects sponsored by the Ministry of Finance, India. Her area of expertise includes corporate taxation, and she presently leads the Institute work on international taxation. Professor Tandon, welcome to the UTDT Global Tax Talks.
Thank you, Professor Passarella and Celina.
Thank you, Suranjali. Before we start our dialogue, please let us make a brief introduction of the situation, the context where we are going to discuss, where we are going to have our discussion. As we all know, in December 2019, a minuscule life form, a coronavirus, appeared on our human world. Since then, it has silently spread using human beings and their advances in technology as a means of transportation. Nowadays, coronavirus is an uninvited guest in our lives and is everywhere. Human beings cannot see it or detect it before its unsettling presence becomes real, once it has infected human beings, jeopardizing their lives. Governments initially reacted to the virus spread, requesting us or directly requiring us to retreat to our homes, disrupting our normal lives. Borders were closed, planes were grounded. We cannot move far from our places of residence, and if we do, in many cases, we are required to comply with the preventive quarantine. We live very much as if we were characters of a science fiction book. Until an effective vaccine is designed to allow us to get back to normal, or the pandemic fades away naturally, hopefully, Now, human beings will continue to be pushed to transform our lifestyles. This transformation includes the way we do business. Social distancing is now the rule, and electronic commerce is widespread. Everything is delivered to our doors or screens, and this behavior will likely remain once we learn to coexist with the pandemic. If we change the way we do business, this for sure has tax implications. So far, governments have used tactics and tools already known to them to deal with this pandemic's effects on their country's economies, and their long-term results are uncertain. In UTDT Global Tax Talks, we will discuss various tax issues derived from the challenges that COVID-19 poses to human beings' economic relations, and how states could deal with them effectively to continue generating revenues to provide the essential services that human beings expect to receive from them. For that purpose, Celina and I have prepared a set of questions that was sent to the speakers in anticipation to our dialogues. We don't know their answers yet, but we will listen to them attentively to provide our conclusions initially on November 11. Professor Tandon will give us a brief introduction before we start with our questionnaire. Suranjali, the floor is yours.
Thank you, Professor Passarella, for that detailed introduction. I think before I start...
You need to share the screen, right?
I'm just about to do that. Before we start with the discussion, I think it's important to sort of set the context. And for that, I will be making a presentation. Okay. So fundamentally, international tax is the confluence, as I may call it, of economics, politics, and law. In international tax, we try to answer questions on who gets to tax a particular income. And essentially what we've seen historically is the answers are given by economists in terms of what is the connection between the economic activity and its relationship to the state. So before I delve into the questions that Professor Passarella has put forth, I think it is important to understand the genesis of the system that we are looking at today. To begin with, I think what has transformed significantly over the past century is that the simplistic relationship, as we all read in our textbooks of economics, is that the production function, where the output was generated conjointly by the efforts of capital and labor, has transformed significantly. In the first half of this century, it was capital that wandered through the world to make returns and set up businesses, and now even labor is mobile. Essentially, economic activity has been distributed across an archipelago, as I may call it, of enterprises set up as subsidiaries, permanent establishments, or branches. With the distribution of this activity, I think the important question that arose is that how do these activities get taxed in different jurisdictions? If we look at the League of Nations report in 1920s, that is the exact conundrum that the economists faced. They were trying to understand how and where should these incomes be taxed so that there is no double taxation, or corporates are not at a unique advantage that there is no taxation. And in their thinking, they had formulated some ideas on the basis of which incomes should be taxed across jurisdictions. And these were the origin, cetus, enforcement of rights and residence. And any income is not a static. It is earned and it is moved across jurisdictions. And therefore, different principles evolved within the international tax system, whether this is the arm's length principle, the permanent establishment, place of effective management. All these rules evolved to sort of allocate the taxing rights between countries. But what has happened is that economic and political circumstances have changed over the last century. There are countries that were not politically sovereign and now are. And therefore, now the order in which incomes are distributed has been called into question. Economic circumstances as well. We see that countries like India have seen a rapid expansion in its GDP. And therefore, I think it has sort of created a contention on now how do we look at these rules and this law that was designed very long ago. There is also an issue of who gets to influence this. Even the League of Nations was aware of this, that there were political factors that influenced how the law was written. And this is also noticed in the discussions that took place during the adoption or the acceptance of the London model of the Mexico model, where instead of giving a wider source country taxation, there was some kind of preference attributed to fixed place of business and the distribution of earnings based earnings proportionately given to companies in a particular jurisdiction. So that link between earning and the jurisdiction had to be established. So what am I trying to say? I'm basically trying to say that at the heart of the problem is the issue of which is a source country and which is a residence country. Notwithstanding that the line has blurred a little bit, there is still a difference. One way in which I could sort of summarize the difference in interests across the globe is this graph that I provide to you. It is sort of a summary of the primary income, which would include wages, interests, dividends, and across the years. As you see, after 2002, there was rapid expansion in payments to OECD members, and there was a rapid outflow from BRICS countries, which basically means that the source and the residence countries look at the international tax system very differently. Now, what has happened in the context of digitalization is that this divide has gotten starker. And it's perhaps because there are multinational companies that seem to be located in particular countries. And therefore, the whole digitalization process has allowed us to re-examine this source-residence relationship. I think the pandemic is another important event in the sense that it will allow us to rethink of this relationship as companies operate remotely and as labor functions are performed remotely. So with that, I think keeping that in mind, we can begin with the questions.
Thank you, Professor. The first question, as we have been making to other scholars, is relating to PEs, okay? Because during the lockdown, MNEs have adapted rapidly, and some of their activities in other countries may have been performed without the need of any local presence. Home office has become the rule, and it may no longer be necessary to commute so often again. Assuming that the international tax system continues to be based on the source versus residence distinction that you have just mentioned, should the concept of PE be revisited or redefined? How? Should these changes apply exceptionally to certain industries, or should they become the general rule? What do you think?
Thanks. That's a very relevant question, Professor Passarella. Basically, operations have been modified, I think, in a more pronounced fashion after the lockdown. But I think this process began much sooner. And if you look at the shift of labor-related activities in the form of business processing units in developing countries such as India, a part of the production began to shift to south, as a proverbial south. And then you had activities such as R&D performed by pharmaceutical companies that also moved here. The last straw, as I may call it, was the remote operation by digital companies on, let's say, data-led services, which moved to countries like India. And that sort of raised an alarm as to whether there is a need for a new nexus rule. I believe that it is now time to sort of question it, because there has been an insurmountable problem before developing countries, not just to say whether the economic activity takes place in the jurisdiction or not, but to what extent can we attribute it to the jurisdiction. As economists, there is much debate on whether the user participation itself can contribute to the value add, and therefore source countries like India, which are markets, can get a right to tax. In fact, if you look at the work that Hal Varian has produced, he questions this premise, saying that it is probably the intellectual property, not the data. And of course, all the brick and mortar enterprises are also going through a change. They are generating incomes that are driven by remote processes, and therefore to characterize them and tax them has become a difficulty. To sort of summarize what the real challenge has been and why I think we need a new nexus rule or a new PE is in this graph. So typically, if there is any income which is derived from an intellectual property or services that are remotely performed, you could bucket them. You could say it is royalty, or it could be fee for technical services, or in a circumstance where there is a permanent establishment, it's profit. Now, for a country like India, each of these have been a challenge. If you look at royalty, there are conflicting outcomes that we have observed, whether a particular payment should be categorized as royalty. Was there a transfer of right to use? Maybe not. In terms of FTS, we have a limited number of treaties that have this article, but again, there is the limitations of make available clause. Then what are we left with? If there are incomes that are not categorized as royalty, not categorized as FTS, they could go untaxed. And if we were to categorize them as profit, if at all, what is the basis on which we would tax? And so far, there has been discussion on the server, for example. Is it fixed place of business or not? So I think because revenues have been able to dodge this problem. What I mean by revenue, I mean revenues of company have dodged this problem of characterization. It is important to pin it down to a permanent establishment. I think this is the crux of the problem, and I think there is also an illustration in terms of numbers what this means. So, for example, I undertake a thought experiment. If we take the global users or digital buyers and take the share of each country in each of these, you see that countries like India top this list in terms of their share. So you have India having 11.3% of global users, 12.5% of digital buyers, which is users who are actually purchasing something. But if you look in terms of revenue, of the global revenue, they account for a very, very small fraction in India, about 1.4% for e-commerce. If you look at China, the situation is very different. They seem to be almost in the ballpark of each other. And in the US, the situation flips. You have more share of global revenues than you have of users. Now, some economists will argue that the price of services is perhaps lower in countries like India. But I'm curious whether that is the only cause, because services in China may also be at par with those delivered in India. So this presents at least the gist of the conflict in terms of which country would require a new PE and which would stand to benefit. So looking at these graphs, I think I can say that there is a need for a new nexus rule. In the current context of the pandemic, digital platforms have thrived. If you look at the revenue of companies like Amazon, there's been a jump of 34% globally. If you look at other companies like Apple, Google, they too have done exceedingly well. And it could be that part of the brick and mortar economy has shrunk to the advantage of the digital platforms. Now, this creates an opportunity to revisit the concept of the PE because a lot of these functions which may have been earlier performed in the place where the sales are made could also be remotely fulfilled. There could be some innovation around that. And therefore, we must revisit the concept. But should we be limiting it to, let's say, just the large tech platforms? I would say no, because the economy itself is going through a transition. If you interestingly look at the submissions that were made to the OECD after the first draft was put out, the Italian Bankers Association had made a representation saying that the proposal could have an impact on the banking industry, which basically says that in varying proportions, different parts of the economy are going through a shift, and therefore a PE, which is sort of ring-fenced around large tech companies, may not be the solution. If you're saying the economy is going to move forward and transform, then a long-term solution means a broad-based permanent establishment rule.
Thank you.
Thank you, Professor. I think that we can move to the second question, which is definitely connected to the first one. So the second question is the current international tax system designed to attribute tax jurisdiction among states fairly so that they can generate tax revenue to deal with situations like the COVID-19 pandemic effectively? Why? If this goal is not achieved with the current system, how could it be attained? Which line of policy should be followed to achieve this goal?
Thanks, Celina. A very relevant question, and I think it follows from the earlier one, as you have said. What is the concept of fair taxation? And in my view, it is that the right amount of tax is paid in the jurisdiction from which it is sourced. And I think the fundamental economic problem there is that the economic activity should be aligned to the taxes paid. Now, one way to deal with it is B, but I think an equally important part is to look at the existing tax system, as in how these profits or these incomes or these assets are reported globally, and whether there's a disconnect for any particular advantageous reason. Now, the international tax system is comprises of various countries having their own domestic laws, and the treaty network is supposed to make sure that the conflicts are resolved and the incomes are allocated appropriately. And while there has been evidence of harmful tax regimes or treaty abuse, I think the premise of the BEPS program was to address exactly these concerns so that there could be a fairer tax allocation. In this regard, I think the minimum standards are important, and I'd like to touch upon three of them, which I think are significant. One is Action Point 5, Action Point 6, and then Action Point 13. If you look at Action Point 5, it was supposed to review harmful regimes in terms of IP. And at the moment, there is only one listed as harmful, and there are 10 under review and 3 in the process of being eliminated, which speaks that there is improvement perhaps in the system. It's a separate question to say whether we should be looking beyond the IP regimes itself. Action Point 6 was to eliminate any sort of treaty abuse that exists at the moment. We can look at it in terms of making the tax treaties more systematic or safeguard them. And I think one of the measures that were adopted in there were the changes to the MLI. And I think if you look at the positions that were submitted by the countries to the OECD for the MLI, the promising trend is 85% adopted the PPT, which is sort of broader in its coverage. So I think that was an improvement. Having said that, I would sort of give a caveat that permanent establishment was not as widely preferred an article in MLI, especially amongst the developed countries. And if we move towards this graph, and I think this is an interesting reflection of the preference for bilateral differences or bilateral negotiation. So if you look at this graph, it basically lists the number of treaties for a particular signatory that will be outside the scope of the MLI. And I attribute the exclusion to the country or the partner. And if you look in the case of Switzerland, it tends to leave out most of its treaties or all of its treaties from the MLI. You see a similar thing for Barbados and Panama, for example. So what this basically reflects is that there might be incentives or there might be a preferential regime which is obviously in the domain of a country's own sovereign decision, but these are not at the moment being resolved through this multilateral process. There is a preference to retain them, and perhaps looking at these might be a good way forward if we are talking about fair allocation of taxes. I think another interesting data set that the OECD has put out recently is the Cbcr Statistics. Now, I will say that at the beginning that this data set is to be used with a lot of caution because numbers may be exaggerated in terms of intercorporate dividends or the inclusion of transparent entities. Notwithstanding such caveats, what we see from this graph here, which is from the OECD's report, is that there are investment hubs globally, where if you look in terms of what the constituent entities of large enterprises located in investment hubs are doing, it seems to be predominantly holding shares. And an aside, which I think will be relevant for our later discussion, is that if you see, there's a large fraction of sales being rendered by constituent entities in middle-income countries and low-income countries. So in a sense, this reflects that there are some jurisdictions that may be used to structure transactions, and there is probably a need to look at them. If just for the interest of those who are attending, I have also pulled out the list of countries that seem to be reporting high proportion of activity as holding of shares and equity instruments. And without without specifically talking about any country, we have those that I think we expect on this graph here. So so what does this basically tell us is that there is perhaps a need to look at the international tax system, which is due for reform. And to sort of end this particular question, if you look at this table now, again the caveat that all these numbers may be overstated, but this is just to show the differences in proportions. Now, if you look at companies where the ultimate parent entity is located, for example, Bermuda, only 0.39% of the employees are reported in Bermuda. Even for a country like India, where you would have accumulated earnings, or you would have cash or employees that are seem to be largely within the Indian economy, the intellectual property and state capital are elsewhere. And if you look at Luxembourg, it's a very curious result that they have accumulated losses and a very small proportion of intellectual property within Luxembourg, which basically takes me back to where I started to say that economic activity seems to be detached, perhaps from taxes. There might be a need for realignment or a reform in the international tax system. And these numbers are just indicative of where we need to look. And we need to think a little bit more of how we want to deal with this. So I think that answers the question of what can be done to make the international tax system fair.
Thank you, Professor Tandon. What struck me from your diagrams here is that there are some stateless companies. So where are they? So it's very interesting. Also, for me, to tell you the truth, it's quite challenging to have a talk with a person that is almost 16,000 kilometers away, and we are discussing this same issue at the same time, and we are seeing each other. So just let me go through the third question, which is still related to this matter that we are discussing. And it goes this way: whether the pandemic is an opportunity to shift the current international tax system to set aside the source and residence concepts. And in that case, if you think that is possible, which should the substitute be and why? And most importantly, what is the role of digital services taxes in this shift? What is your opinion?
Thanks, Professor Passarella. This is a very relevant question, following again from what you just spoken. I'd like to clarify, when I started this presentation, I showed that there is a divergence of interest, even the table that I showed earlier in terms of users and revenue. There seems to be a difference between source and residence. So to set aside this difference is a little difficult because it is, as I said, the heart or the core of the international tax system. But nevertheless, that doesn't rule out scope for reforming it. Is it a process of making source-based tax system better? I want to start with this table again, which I had shown earlier. And if you look at the marketing and sales distribution activity, as you can see, it predominantly happens outside the jurisdiction of the parent entity, which means that part of the activities are located elsewhere. Even if you look in terms of intellectual property, right? Countries like India, South Africa, they are located elsewhere, which means that there will be corresponding income flows, which will again require that the distribution of taxing rights is properly defined. And I think one of the solutions that we are sort of hoping would come out of the OECD dialogues is consensus on unified approach. I do not want to deliberate very much on it, but what I can say is that even the unified approach itself is looked at by countries in different manners. So it fundamentally wants to redistribute taxing rights, but it does so in the basis of defining a routine profit and a non-routine profit, and the non-routine profit would itself be problematic, and I will delve into that a little later. But the issue again is, how do countries view this redistribution, right? So if you look at OECD's own estimates, there are developing countries or small middle income and low income countries that would gain at the most 2% of their total corporate tax revenues. And therefore, I feel there is a fundamental conflict which I think can be resolved, but it would be through the long-term solution where countries see that there's fair allocation. Now, one sort of emerging tactic to move away from source and residence complications which exist is to apply the digital services tax. I would say that the digital services tax should be viewed very differently. It should be viewed as the measure to get everyone to build consensus. The two major drawbacks that are listed of the digital services tax is that it leads to overtaxation or it generates little revenue, which is the case in India. For example, the equalization levy for the longest time has generated very, very small revenues, and people point to it to say that this is not useful at all. But in my view, I feel the pandemic has been useful. Why? Because the profits of large tech companies have given an opportunity to levy this tax so as to bring countries to have a conversation about what should be the right way to tax internationally. And in terms of overtaxation, there is obviously evidence of pass forward. And in terms of little revenue, I think just the revenue of the tax from the tax should not be looked at in terms of evaluating the digital services tax, because if there is a shift in structuring of companies as a result, you would see an improvement in corporate taxes. So I believe that digital services tax is an intervention which can sort of rebalance or reset this source and residence based distribution of taxing rights.
Thank you, Professor. I think that we are in a position to move to a transfer pricing question. So the question is, as you know, the pandemic affects the multinational intercompany transactions comparability. So which are the challenges and possible solutions to determine the arm's length range during this economic downturn?
Thank you, Celina. I think transfer pricing will pose immense risk at the moment because there has been a substantial shift in revenues and profitability, even for companies within a sector. At least that's what we're observing even in India. But to begin with, I think transfer pricing is an important issue, not just because of this, but also because it relates to allocation of taxing rights, right? So one, how do you attribute? And I think the major challenge to transfer pricing so far has been comparability. It is a recurrent issue in India. A lot of people look at India as a regime which has had a lot of trouble implementing transfer pricing. We have, I think, the largest stock of transfer pricing cases. And I think the problem is comparability. And this has been compounded, I would say, in the last couple of years because of two important factors. One is that there has been concentration of companies within sectors, especially IT, ITES. And there has been an integration of operations. So there's an inseparability problem, as in how do you, distribute between functions that may have been performed jointly. So, so I think that is one major challenge, and in fact, the Indian courts have dealt with this issue repeatedly. So I think one of the most important and critical and unresolved controversy for India has been whether a small firm really is comparable to a large firm. And in most cases, this was dealt with in different manners, looking at turnover filters to say that, a company with a revenue threshold above or below is not comparable. But it's like drawing a line in the sand. Where do you say that these are not comparable? And so to answer that question, I actually looked at Indian companies, and I found that companies with a share more than 1% of the total market seem to have very high profitability in comparison to those below it. And what this really means is that with the pandemic, if there is going to be concentration, if there is going to be difference in profitability, which is lack of comparability, we're going to head in for some problems with applying the arm's length principle. And in fact, this relates also to the unified approach, because if there is an incomparability, how do you define a routine return under such circumstances? Just to give you a sense of what has happened in India, if you look at just the IT-enabled services, the computer software industry, if you look at number of companies that had more than 1% share of the market, has substantially declined. And what that means is that it reflects on the problems that we might have with comparability. In addition to this, I might just add that there have been disruptions in the supply chain, and therefore any foreign exchange fluctuations in the interim could also pose risks in applying the arm's length principle. Thank you.
Thank you, Professor Tandon. I think that we are going to move to another controversial issue, which is whether in this pandemic it is a good idea that countries start levying a one-time or perhaps a regular wealth tax on its taxpayers. And what are your views about this? And do you have any thoughts about whether this tax may affect investment in the countries that levy the wealth tax?
So this is a question I think that all economies are now revisiting. And I think part of the motivation to ask this question is that we have woken up to broken income tax systems. For the last couple of decades, the income tax system was designed to give incentives to investment in the hope that it would take the economy on to a higher path of growth. And I think that has also been the thinking in developing countries. But what has happened is that there has been a perverse result in terms of distributional consequences. So while I feel that it is a relevant question to ask, whether we can address this with the imposition of wealth tax, the answer would be this, is to say that we need to understand first, how is wealth held? I think that's a very important question because in many countries it is observed that some of this wealth is held offshore. Now, if you look at studies such as Damgard et al., they seem to suggest that 9% or 10% of the GDP is held offshore as wealth by private individuals. And in any attempt to sort of tax, you may not get the revenues that you aim for. And this might be particularly pronounced for countries like Argentina or Venezuela. And therefore, when the wealth tax is applied, will that result in higher revenues? Is a big question that needs to be asked. I think the second and another important issue is that whether all countries are willing to do this. So, for example, just as we've seen in the last couple of slides, if economic activity can be displaced by certain incentive regimes, even wealth, which is like an economic activity, can be displaced. So therefore, if there is an uncoordinated effort by specific countries to levy, will there be a flight of capital, which also has adverse consequences for less developed countries? That is another consequence. And I think third one, I don't know how important it is across the world, but perhaps also worth considering is the consequences for debt. For example, countries such as India are extremely leveraged, especially the corporate sector seems to be borrowing a lot. And if a wealth tax is calculated on net wealth, will that create an incentive to borrow to reduce the liability? So I would say that it has to be cautious. One has to be cautious when applying the wealth tax, and also very considerate of the underlying economy. So a similar tax cannot be envisaged for all the economies. So that would be my response to your question.
Thank you very much.
Thank you, Professor. So the next question is related to the reaction to the taxpayer. How do you think that taxpayer would react in general to any potential tax increases during this pandemic? Could their government's approach to deal with the pandemic have any implication of term of tax reform and taxpayer willingness to accept a tax hike? Thank you.
Yes. So if I've said at the beginning of the wealth tax that the income tax system perhaps was broken and therefore wealth tax is trying to fix that, then the natural question is, if you cannot implement a wealth tax and hope for it to pay for the pandemic, then what else is the solution? The other solution, also imagined by many now, is the increase in income taxes. But I believe that this again comes with its own risks. Just taking the example of India, so I've done some calculations to sort of explain why this can be done or why this can't be done. So if you look at India's taxpayers base, it's only about 7% of or 8% of the total population. So essentially, we're saying that the 8% of the population will have to pay. Now, if you look at distribution, and I think that's a more important feature, is to say where are these taxpayers in the scheme of income distribution. And if you look at the tax information that is available, bulk of the tax from personal income taxes comes from the low end, right? And in India last year, in order to sort of introduce some progressivity, a progressive surcharge was implemented, taking the highest marginal tax rate to 42%. This did create some kind of this just upset the foreign investors. But nevertheless, we've gone ahead with this and excluded the foreign investors from this application. Now, can this result, can raising the personal income taxes result in higher tax revenues? Maybe not. What I believe is that the entire distribution of taxpayers will have to be taxed, which means even the lower taxpayers will have to pay more. And I think that's a difficult proposition at the moment. If we were to flip this around and say, okay, can we increase corporate taxes? Now, if you look at corporate tax distribution, 75% of the tax is paid by 0.22% of the returns filed, which essentially means that the big companies will pay this tax. Unfortunately, we have committed in India to a lower corporate tax rate, and therefore the economic intent of a higher tax will sort of cancel out the other economic goals that we have envisaged, and therefore this makes increase in corporate taxes difficult. And I think the third and a very important factor is that the tax base itself is going to shrink. In my estimates, the base for the corporate tax collections and personal income tax collections are expected to go down to close to 10%. And in the first quarter, the GDP numbers look very bleak, with a 23.9% decline quarter on quarter. So, in my view, at the moment, if the government were to raise taxes, it would dampen demand, which I think would be true for other countries as well. And in a sense, the impact of raising revenues from an increased rate would be negated by reduction in incomes. So I think it's difficult to impose an immediate and substantial increase in taxes, income taxes. Thank you.
Thank you very much. We are reaching our seventh question, which is the following. Does this pandemic require policymakers to think out of the box, to find new collaborative solutions to help the poorer countries? In other words, do poorer countries have a claim to receive tax revenues from richer countries to help them cope with crises like COVID? And should there be tax transfer from rich countries to poor countries? What is your view?
So my answer will be a little different from the question. I feel that the redistribution is sort of dealt with all the earlier points that I've made, which I will say in my concluding remarks. But I think there is need to innovate around how we tax in general other incomes, and this should be across the globe. Now, just one of the graphs that I want to present is to show that in this, a peculiar sort of trend has been observed during this crisis, and this is true for countries across the world. And if you look at this graph, the red line is for Argentina, and the purple line is for India, and I think the one below is for S&P. Now, what this graph really shows is that when the lockdown was implemented, there was a dip in the activity in the stock market, and thereafter it has accelerated in complete disconnect of what has happened in the economy elsewhere. And some of this has got to do with the liquidity infusion or the promise of a fiscal stimulus, which basically means that the gains that were envisaged from the stimulus and from the expansion of liquidity was actually driven elsewhere. And I think one of the questions that we have been revisiting since the financial crisis, the global financial crisis of 2008, is, how does stock market add to economic value added, and how should it be taxed? In fact, there has still been no consensus on the application of financial transactions tax. What this graph really says is that there are some people in possession of capital gains who have profited from a market that is not in line with economic activity. And perhaps it is time to think of how we can better tax this market. Because what I find in India is that, let's say, for example, even if the stock market went up and there were companies that could raise capital and get themselves out of distress, I would say it's a big plus. But what I notice for India is that, in fact, stressed companies do not have an equal access to equity markets. And therefore, that goes back to the fundamental question I think all of us in taxation try to ask ourselves is the deductibility of debt, first of all, from profits, and the other is that whether equity should get a preferential treatment in capital gains. And I think it's time to sort of revisit each of these questions. For debt, of course, because there has been exceptional increase in debt usage in the past years, which in India seems to be driven partly by taxes. And we should also look at the debt versus the equity arbitrage. I think, having said that, the other thing is that there are incentives that have been offered in the past in the hope that economic activity will pick up, and perhaps some of these incentives need to be rationalized. From the entire presentation, I think one point that I may have made amply clear is that economic activity, which is the basis of taxation, should be realigned with taxes paid, and that requires that we examine the treaties and domestic tax laws again to see wherever there may be gaps and bridge those. And all of this requires coordination. Uncoordinated moves are not going to yield the result that we require. And I think lastly, which is an important point to make, especially in regards to the pandemic, is that we cannot rely only on taxes. Most countries are now looking at borrowings, right? And the fiscal stimulus packages is going to be financed by greater borrowings. And while this may mean that over the years we could imagine higher tax rates, which could be gradually increased, which is a better way to do it than a one-time shock to taxes, I think there are other ways to deal with it. For example, now if you read, there are conversations about shift to stakeholder capitalism. So there is something called the principles of responsible investment that also look at the fair taxes, that the taxes paid by companies are fair. So I think those kind of measures can actually be innovative and can reset taxes for the future. So I believe that is the way forward.
Thank you very much, Professor Tandon, for sharing your thoughts on these very interesting and challenging issues. So we have a question from our audience, and it is related with the following question. What do you think that would be the impact of the rise of India on the international tax regime?
We've been noticing, I think, over the last couple of years, the proactive role that India has taken in discussions, and I think it has nudged international institutions to step up and sort of take notice of the proposals. I believe the implementation of the SEP or the equalization levy has created room for countries like India to sort of position what they think. And that is being actively considered. And I think that's a major shift in thinking. So I think India could assume a significant role going forward.
Thank you. I think that the question that also comes to our mind at this point is whether the global tax system could be remade to provide a better position to the base of the global economy. And how could that be? Do you have any views on this? I mean, there is a pyramid of the economy. How could we help the poor?
So that's a very astute question, and I think it requires elaborate answer. But I think at the moment, there is an issue of, I think, timing. What we're expecting from the international tax system is a quick fix, whereas it requires time to settle and change. I think an immediate measure could be that the income tax system could be made more progressive. The income brackets where we think there are revenues to be gained, that needs to be considered, and a long-term shift has to be made in terms of higher minimum taxes. Alternatively, as I've suggested throughout the presentation, is that we need to re-examine the treaty system. For example, how that interacts with domestic tax laws. Interestingly, we've noticed that countries like Kenya have got up and questioned the treaties that they have signed in the past, and questioning these, and this is great. I think it's promising. So I think that's one possible way out.
Thank you very much. Celina?
Thank you very much. What do you think about the role of Latin America in this new tax regime, in this new area of international tax system design?
I feel that there is a role for all developing countries at the moment to sort of build consensus between themselves. Because I feel that there is a preference even amongst developing countries for a particular kind of innovation or a particular kind of tax. Having said that, I know that there are very many differences. For example, Brazil might respond to legal changes very differently. So, having said that, I believe that perhaps if developing countries along, which include India and some in the Latin America, can agree on a shift, at least in terms of how they tax digital companies, that could be a way of building consensus and partnership forward. So I think Latin American countries have great role to play.
Okay, and do you think in that case that the new model, Article 12B of the UN model, may be a way to go, or is it bad for the tax system, the international tax system?
So my view is that we can implement the digital services tax and then negotiate for it to be a withholding tax. So move to a system where it's a withholding. Now the problem with having any tax, any new withholding which is ring-fenced or limited, might be a problem going forward. As I said, that once you say that you're going to tax only specific kind of activities, if your economy is going to transform in next 5 years and it's going to be very different from how you view it now, we'll have to go and do this entire process of negotiation again, which I think is time consuming. So I think it's better to sort of take another route than the one being suggested. Yeah.
Definitely in 2015, we didn't know that we would be like this 5 years from now, from then. so I completely agree that we don't know where we are going to be 5 years from now. So I think that we can agree with that. Celina, I think that we are reaching the end of our 7th dialogue. Do you have anything that you want to ask?
Just to say thank you to Professor Tandon. Thank you for sharing your thoughts. It was very interesting, your viewpoint from India and from an economic. So thank you very much.
Yes,
thank you so much, Celina.
It was very, very nice to talk to you. Very interesting to listen to your views, and look forward to staying in touch as we hope with the rest of the speakers as well, those that have already spoken with us and those that will speak with us in the next few weeks. As we all know, we have our 8th talk next week. We continue our trip around the globe, around the world. Next time we are going to be speaking with Professor Yan Shu. She's a professor from Australia, but she's Chinese. And we are going to be speaking with her about these same questions. It will be on Wednesday at a different time because of the different time zones. Okay, so it's going to be 10 p.m. GMT, which in Argentina it's 7 p.m. in the evening of the Wednesday, and it will be in the morning of Australia. Okay, so until then, take care, wear your masks. See you in the same tax channel at the same, well, at a different tax time this time. See you then. Thank you, Celina. Thank you, Suranjali. Okay, see you. Bye-bye.
Thank you. Bye.